S&P 500 hit the highest point ever after hitting over 5,300 for the first time ever in its history. And why did it hit the highest point ever? Everyone knows that the only reason S&P 500 is doing so well is really because of only one sector, the technology sector. The technology sector, and in particular microchips and semiconductor companies, are absolutely crushing everything. Take companies like Google and Amazon, all absolute giants in this space, but microchip company Nvidia is close to beating them in total market capitalization. Nvidia market cap is almost $2.7 trillion, whereas Google and Amazon combined together the market capitalization is almost $3 trillion. Nvidia is up 120% this year alone with a market capitalization of almost $3 trillion. Nvidia is the world's third most valuable company by market capitalization, beating Amazon and Google. For example, if you invested $10,000 into Nvidia 10 years ago in 2014, today you would have over $2.5 million. If you would have invested in Nvidia way back then, you would be very happy today. But right now it's literally at the highest point. It would be more risky to buy Nvidia right now after a crazy run in my opinion. Nvidia's stock is still increasing and it's definitely not going away anytime soon. But it would be risky to buy this one company or any one semiconductor company, but to buy an ETF that has a bunch of this type of companies might be a very smart move to cash in on the semiconductor growth. And also the ETF will mitigate your risk and make sure that you have different companies just in case one of them falls, then the other will hold your money up and growing. In this video, we are going to highlight two semiconductor ETFs that should not only beat the S&P 500 in the near term, but they will beat S&P 500 in the future as well. These are hidden gems poised for explosive growth, these best semiconductor ETFs that are not just powering our devices, but also powering the future of investments. Let's get started. Thank you again for joining me today. I am Pankaj. As always, everything shared in this video is for informational purposes only. This first ETF on the list is probably the one that's the most growth centric and heavily weighted towards top performing semiconductor companies. But it has an incredible track record since its inception in 2011. Its ticker symbol is SMH, VanEck Semiconductor ETF, issued by VanEck Associates Corporation. When we compare its performance with S&P 500, its performance is a lot better and the return is several times more than S&P 500. SMH has shown significant growth due to the increasing demand for semiconductors. It has always performed better than S&P 500, which can be seen here. If you had invested $10,000 in SMH ETF 10 years ago, it would have become over $113,000 in just 10 years with an annual rate of return 27%. SMH is a technology-focused ETF and its top 10 holdings are Nvidia, Taiwan Semiconductor, Broadcom, Qualcomm, Texas Instruments, Micron Technology, and many more. The overall weightage for top 10 holdings are almost 75%. This ETF uses a modified market capitalization weighting index, meaning larger companies have more influence on the ETF performance. The question investors may ask, why should we invest in this ETF? There are several factors which tells us why we should consider this growth ETF. First, it has exposure to a key sector. Investors gain exposure to the semiconductor industry, which is integral to the tech ecosystem these days. Second, great diversification among semiconductor sector. Holding shares in SMH provides diversification within the semiconductor sector, reducing the risk associated with investing in a single company. Third, the growth potential. The growing demand for semiconductors in various applications like AI, 5G, and IoT presents significant growth opportunities. Further, the expense ratio for SMH is just 0.35%. It means that to manage $10,000, the fund will charge $35 as an expense fee. Funds under management are almost $20 billion under this ETF. The investment sentiment for SMH is bullish and it is recommended as a strong buy from several Wall Street analysts. This ETF strategy is great for both long-term investors and short-term investors, since long-term investors can capitalize on the growing demand for semiconductors. Also, the short-term investors can benefit from the ETF's volatility and industry news. The second ETF I am going to talk about is Invesco PHLX Semiconductor ETF with ticker symbol SOXQ. Just want to bring your attention, if you are getting any value out of the analysis, please hit the like button and subscribe to the channel. Let's get back to the ETF SOXQ. There are few reasons why SOXQ ETF is a great pick for long-term investors. Let's check few facts. SOXQ has an exposure to a high growth sector due to increased semiconductor demand and technological advancement. Semiconductor demand is booming due to their critical role in several high growth areas such as artificial intelligence, 5G technology, electrical vehicles, and Internet of Things devices. This ETF has sector-specific exposure focused to the semiconductor sector, allowing them to benefit from the growth in this specific industry without the risk of investing in individual stocks. Again, this is a technology-focused ETF and its top 10 holdings are Nvidia, Broadcom, AMD, Micron, Qualcomm, Taiwan Semiconductor, and many more. The top 10 companies have a weightage of almost 62%. SOXQ has shown strong performance which can be seen from its historical returns. SOXQ has historically outperformed many other sectors due to continuous innovation and increasing demand for tech products. SOXQ ETF is relatively new and in the last 4 years its return is almost 62% and in the last 1 year alone the return is 48%. Expense ratio for this ETF is low compared to SMH, only 0.19%. It means it will cost only $19 to manage a fund of $10,000. Assets under management under this ETF is just over $400 million. When compared with S&P 500, SOXQ has been performing better since its inception in 2021. If you had invested $10,000 in SOXQ 4 years ago, it would be almost $17,000 today with 19% rate of return annually. Since both ETFs in discussion today are from the semiconductor sector, let's check their overlap in number of holdings and their weightage. SMH has 21 stocks in its basket and SOXQ has 33 stocks in its basket, and 21 of them are common between these two ETFs. Both SMH and SOXQ are semiconductor sector ETF and they both invested in almost the same companies. However, their weightage may vary. I'll show you an illustration to highlight the overlap between the two. They have 74% overlap by weight. It means that if you hold both of the ETFs in your portfolio in the same proportion, 74% of your money is invested in the same company, even if you have two different ETFs in your portfolio. When we look at the overlap further, the top 10 companies have almost 60% overlap in weightage. It means that your 60% of the money from both ETF is invested in only top 10 companies. To conclude, as an investor, the question may come, which ETF should we invest in, SMH or SOXQ, or both? Since they both are from the same sector, 74% of their fund weightage is the same, I will leave this decision on you. But at the end, I would like to highlight few differences here. SMH tracks the MBIS US listed Semiconductor 25 index, which focuses on the top 25 US listed semiconductor companies. Whereas SOXQ tracks the PHLX Semiconductor Sector Index, which includes a broad range of semiconductor companies and might have different criteria for inclusion. What does it mean? It means SOXQ are more diversified than SMH, which tells us that SOXQ is less risky and SMH has high growth potential. When we look at their expense ratio, SMH has a slightly higher expense ratio compared to SOXQ. Further, their geographical exposure also differs slightly. SMH is mostly US focused, but it includes companies that have significant global operations and some non-US companies. Write down in the comment section if you got something out of value in this analysis. Also, if you found this information valuable, don't forget to like, share and subscribe for more financial insights. Until next time, happy investing.